It is always good to have you on the show. So as Julie was pointing out, maybe we're taking a bit of a pause here, Sam. Of course, we've had a strong run. What do you make of this market, Sam? Just where we are and where you think we're headed?
Hey, Josh, good to talk to you again. Yeah, I think at least in the near term, we're probably headed a little bit higher. But I am getting increasingly concerned that we have to endure another decline of 5% or more before the year is out. I point to history for making that statement. This was the 11th best first quarter return since World War II. And of the top 15, 14 of them had declines of 5% or more. And then if that decline was actually less than 10%, we had a repeat. And the average decline was about 12.5%. The good news, the silver lining, is that each one of these 15 years posted full year gains, with the average being above 20%.
So that seems to bode well, Sam. But in the meantime, when you talk about the possibility of that pullback, what are your main contenders for what could trigger it?
Well, I guess the real problem is that the market tends to get tripped up by unanticipated events, and unanticipated events are hard to anticipate. But I would tend to say that if we end up just moving too quickly, right now the S&P 500 is trading one standard deviation above the average difference between its 200-day moving average and the index itself. So I just feel that if we get too far above, we're time to have some sort of resetting of the dials, digestion. If we start to see other economic indicators that point to an economic slowdown that causes investors to worry that maybe we are headed for recession rather than simply a soft landing. Let's face it, today's consumer confidence was something that was not anticipated. But at the same time, I still feel that these kind of resettings of the dial are healthy for the market.
Also, Sam, so you're talking some technicals there. Also interested, though, Sam, just to get your take on valuation here for the market. At these levels, how's it looking?
Looking pretty pricey. Yes, the S&P 500 is trading at a 30% premium to its 20-year average PE. We're also looking at tech that's trading at about a multiple of 30, which is looking sort of like a very firm ceiling for that group, also trading at a hefty premium to its longer-term relative PE. Those groups that are actually attractively valued from a relative PE discount perspective, not surprisingly, mid caps, small caps, energy stocks, as well as utilities.
And let's talk about the other side of that coin, right? In big cap tech, as I talked about earlier, they continue to be dominating returns here. When you look at the major averages, accounting for a lot of the gains we've been seeing. Where do we go from here on that front? I mean, these guys are still setting records.
Oh, they sure are. Technology was the best performing group on a year-to-date basis. Also, just in the past week, technology was up almost 6%, while the S&P was up less than 2%. And technology was the only outperforming sector. So I guess another worry could be how long can this jumbo jet fly on only one engine? But my feeling is that historically, in election years, when you do have the top three performing sectors midway through that year, they tend on average to be outperformers for the second half as well.
And Sam, just one other sector I want to kind of dig deeper with you on is utilities, because we've had some smart strategists come on the show and really pound the table on that one, saying it's a smart way for investors to kind of play offense and defense at the same time. But you're actually underweight that sector. How come, Sam?
Well, because what we look at is not just the momentum of the group, but also the percentage of stocks in the category that have buy and strong buy recommendations. And our analysts basically are pointing to the fact that only 3 of the 31 companies in the S&P 500 utilities sector index are really AI related and are posting above average returns. Take out those stocks and the sector would be underperforming. So I think you do have to be fairly selective. Yes, there will be increased power needs for the data centers, et cetera. But I think you have to be very selective as to which stocks to go for.
Sam, one of the things that we've noticed as of late among some of the large cap tech, but just more broadly, are new stock splits being announced. And I don't think the numbers necessarily on an absolute basis are going up, but we've got a lot of high profile companies. We had NVIDIA, we had Broadcom announcing them. Does that say anything about the sort of general vibe of the market at all?
I think it does. I think it indicates that company management is feeling more optimistic about the future. And so they are willing, in a sense, to make their share prices more accessible to a greater number of investors. Institutional investors focus more on the dollar value, but retail investors look to the price of the underlying stock. Remember, I go back a long way, and it used to be that a stock wanted to split if it got between $40 and $80 a share to make it more appealing and affordable for investors, because back in the 60s, 70s, et cetera, prior to commission-free trading, it was a lot less expensive to buy a round lot or multiple of 100 than it was an odd lot. Also now today, however, with commission-free trading, with the fractional shares, basically it's not much of a concern, but it is more of a psychological tailwind for that company.
Sam, shifting gears a bit here, I'm also interested to get your take on politics and just sort of the kind of political uncertainty we're now seeing really kind of on both sides of the Atlantic, Sam. Of course, in Europe, you saw what happened there. Things seem to be on the move, maybe a real shift to the right there. Of course, here we have the election coming up. How, as a market strategist, Sam, are you trying to think through all that?
Well, that's a good point. I mean, we do have our Washington analysis arm, which monitors all of the bills going through Congress, but also monitors the polls to see which candidates are ahead. And right now, the thought is that if the election were today, Trump would be the victor, and the U.S. would too also be shifting more toward the right. What it reminds me of are years like 68, like 1980, like 1948, when you actually had third-party candidates involved. And basically with Robert Kennedy Jr. now in the race, along with Trump, Biden, where they are split evenly right now, in many ways, it's anyone's guess. Historically, it used to be that the market's return from July 31 through October 31 was a very good indicator. An upward move pointed to a re-election, a downward move pointed to a replacement. But with asterisks, usually the third parties can be disruptors.
That is really interesting, Sam. We will keep an eye on that return with the asterisk in mind. Good to see you. Thanks so much and have a great weekend.
Thanks, you too.